On Wall Street, your title does not always mean what you think it means. A vice president is not necessarily close to running the bank. An associate is not an entry-level assistant, and a managing director may earn millions of dollars in 1 year, then face pressure to justify his position the next. At the bottom of the hierarchy, you are paid to build. You build financial models. You build presentations. You build valuation tables. You check numbers that may eventually influence a multi-billion-dollar transaction, but you may never speak during the meeting where those numbers are presented. At the next rank, you are paid to check. You review the analyst's model. You correct the presentation. You coordinate the work. And when a senior banker changes the assignment, you make sure the entire team changes with it. Then you become a vice president. You are no longer responsible for completing every task yourself. You are responsible for making sure every task gets completed. After that, the job changes again. At the senior levels,
technical ability is no longer enough. You must find clients, win mandates, generate fees, and convince chief executives, boards, and private equity firms to trust your bank with the most important transactions of their careers. The higher you rise, the less time you may spend inside Excel. But the danger does not disappear. It changes. At the bottom, a mistake can destroy your night. At the top, a weak year can destroy your value to the bank. Current industry estimates for New York front office investment banking place typical total annual compensation at roughly $165,000 to $225,000 for analysts. For junior managing directors, estimates can reach approximately $1 million to $2 million or more. But that difference is not simply a reward for surviving long enough. It represents a complete transformation in what the bank is buying from you. First, it buys your time. Then, it buys your judgment. Finally, it buys your relationships. This is your life at every major rank in investment banking. And the most important thing to understand is this. You do not reach the top by becoming the best analyst. You reach the top by becoming something the analyst was never hired to be. A salesperson.
Investment banking is often confused with investing, but investment bankers do not spend every day choosing stocks for a portfolio. Their clients are usually corporations, financial sponsors, institutions, and governments. Those clients may need to acquire another company, sell a division, raise money by issuing shares, borrow through the debt markets, restructure obligations, or defend themselves against an unwanted takeover. Investment banks advise them and help execute those transactions. Goldman Sachs describes investment banking work as including cross-border mergers, initial public offerings, and bond refinancings. JP Morgan divides much of the work into advisory, capital markets, and industry coverage groups. The bank may be hired because it understands a particular industry, because it can arrange financing, because it has relationships with potential buyers, because its name gives credibility to the transaction, or because its senior bankers have spent years advising the people making the decision. This business creates a basic division of labor. Junior bankers analyze and produce. Mid-level bankers organize and execute. Senior bankers advise and sell. The hierarchy exists because a transaction can require enormous amounts of work. Financial information must be collected, companies must be valued, presentations must be prepared, potential buyers or investors must be identified, due diligence must be coordinated, financial alternatives must be analyzed, documents must be reviewed, internal approval must be obtained, and every important number must survive multiple layers of checking. That means your position in the hierarchy determines more than your salary. It determines which part of the machine you are expected to control.
But before you receive an official rank, you normally face an extended audition, the internship. The intern is not always treated as a permanent rank, but for many future analysts, it is the point where the Wall Street hierarchy begins. JP Morgan's summer analyst program includes training in accounting, valuation, financial modeling, and Excel before interns work with banking teams. Goldman Sachs describes its summer analyst program as an opportunity for students to become immersed in the firm's day-to-day activities. But the internship is not simply educational. It is a hiring process. The bank is testing whether you can learn quickly, whether you can follow instructions, whether you can handle detailed work, whether senior team members trust you, and whether they want to work with you again as a full-time analyst. As an intern, your independent authority is extremely limited. You may assist with research, update company information, support valuation work, help prepare presentations, and observe how junior bankers respond to requests from senior team members. Your work must be checked because the bank cannot assume that a student with limited experience understands every accounting adjustment, transaction convention, or compliance requirement. That does not make the work unimportant. It makes accuracy more important. A visible mistake does not only communicate that one number is wrong, it can suggest that your work cannot yet be trusted without extensive supervision. The intern's central problem is simple. You are supposed to contribute before you fully understand the system. You are learning the language while being evaluated on how well you speak it. And unlike a normal university exam, the final result may not be a grade. It may be a return offer. If you receive one and accept it, you enter the first official level of the hierarchy, the level where Wall Street begins buying your time.
Analysts are commonly recruited from undergraduate programs. The traditional analyst program lasts approximately 2 or 3 years, although promotion structures vary by bank. At this level, your primary responsibilities fall into 3 broad categories: presentations, financial analysis, and process administration. You help build pitch books used to propose ideas to clients. You update market and company information. You collect financial results from public filings and other approved sources. You build or maintain valuation models. You analyze comparable public companies. You examine previous transactions. You may help construct discounted cash flow analyses. You track comments and revisions. And on live transactions, you may maintain process materials, buyer lists, working group lists, and virtual data rooms. JP Morgan's full-time analyst program explicitly describes analysts as writing reports, updating financial models, and supporting transactions that may be worth billions of dollars. The scale creates a strange contradiction. You may work on a multi-billion-dollar acquisition
While spending part of your time correcting alignment, fonts, footnotes, and page references in a presentation, this is not because formatting is more important than valuation. It is because the final document represents the bank. If a presentation contains visible errors, the client may wonder whether the invisible analysis contains errors too. The analyst therefore works at the level where small mistakes become credibility problems. A number must not only be correct, it must be current. It must be sourced. It must be presented consistently. And it must remain correct after the assumptions change. That last part is where much of the pressure originates. Investment banking work is controlled by transactions, clients, and senior decision makers. A presentation may be revised because a new idea has emerged. A valuation may need to be updated because market prices moved. A deal structure may change. A client may request an alternative analysis. A senior banker may decide that the presentation needs a different message. The analyst sits at the bottom of this chain. Many of the changes eventually reach the analyst's screen. This is why the hours can become extreme. In 2021, a self-selected group of 13 first-year Goldman Sachs analysts reported averaging 95 hours of work per week and approximately 5 hours of sleep per night. That was a small and unusually stressed sample during a period of exceptional deal activity. It should not be treated as a universal schedule for every bank or every week, but it documented how severe junior banker workloads can become. Hours vary by firm, group, market cycle, and deal activity. A quiet period may look very different from an active transaction, but the basic lack of control remains. The analyst does not decide when the client calls. The analyst does not choose when a transaction becomes urgent. And the analyst does not control how many comments arrive before the work is finished. Current industry estimates place New York analyst base salaries at approximately $100,000 to $125,000, with typical total compensation around $165,000 to $225,000. That is an extraordinary income for someone near the beginning of a career. But salary alone does not explain the bargain. The bank is paying for analytical ability, attention to detail, and availability. At this level, you can be highly paid and still have very little control over your own time. If you perform well and remain at the firm, you may be promoted. Then you become responsible not only for your own work, you become responsible for someone else's. Associates usually arrive through 2 routes. Some are promoted from the analyst class. Others join after an MBA or relevant professional experience. The associate still works with models and presentations, but the job is no longer only to produce. It is to supervise production. The analyst builds the model. The associate checks whether it works. The analyst updates the presentation. The associate makes sure it tells the correct story. And when comments arrive, the associate distributes the work, reviews the revisions, and keeps the team moving.
This makes the associate a bridge. Below are analysts who need instructions and review. Above are vice presidents and senior bankers who expect accurate work delivered on time. If a number is wrong, blaming the analyst is not an adequate defense. The associate was expected to catch it. This is the transition from doing the work to owning the work. Associates also begin communicating more directly with clients, coordinating information requests, and helping manage live transaction timelines. Technical ability remains essential, but communication, delegation, and judgment become more important.
Recent New York estimates place associate base salaries around $175,000 to $225,000, with total compensation potentially ranging from approximately $285,000 to $500,000. Bonuses vary with individual performance, firm performance, and market conditions. To move higher, an associate must prove that a team can operate through them. That leads to the title outsiders misunderstand most: Vice President. In many industries, Vice President sounds like one of the company's highest positions. On Wall Street, there can be large numbers of VPs. An investment banking VP is senior to analysts and associates, but still below directors and managing directors. At this level, your central responsibility is execution. You coordinate teams, review analysis, manage client materials, work with lawyers, accountants, and other advisors, communicate with the client, and make sure senior bankers know what is happening. The analyst asks, what needs to be built? The associate asks, is it correct? The VP asks, will the entire process move forward? Technical excellence is now expected. The real differentiator is judgment. You must know which problem requires immediate escalation, which deadline can move, which issue could threaten the transaction, and which client concern is more serious than it appears. Senior bankers may win the assignment, but the VP must help deliver the work that protects the relationship. A deal can be won through senior credibility and lost through weak execution. Recent estimates place New York VP base salaries near $250,000 to $300,000, with total compensation potentially ranging from approximately $525,000 to $800,000. But compensation becomes more variable as seniority rises. The VP is valuable because the bank needs the transaction controlled. At the next level, however, execution is no longer enough. You must begin helping create the transaction itself.
The title at this level varies by bank. Some institutions use director, others use executive director or senior vice president. But the purpose is broadly similar. The director sits between execution leadership and full revenue ownership. You are expected to understand how deals are completed. Now, you must also help generate them. That means identifying companies that may need advice, understanding industry changes, maintaining relationships with executives and investors, developing ideas, and turning those ideas into formal assignments. At junior levels, knowledge helps you perform the analysis. At senior levels, knowledge must create an opportunity. This is why directors are often described as rainmakers in training. A rainmaker brings revenue into the firm. But becoming one is difficult. The skills that made you a strong analyst do not automatically make chief executives return your calls. And the skills that made you an effective VP do not guarantee that a client will choose your bank. You must build trust, even when there is no immediate transaction.
A senior banker may maintain a relationship for years before winning a major mandate. Many ideas produce no deal. Many pitches produce no fee. And many transactions are delayed, rejected, or awarded to competitors. Current estimates place New York director or senior vice president base salaries around $300,000 to $350,000, with total compensation potentially around $700,000 to $900,000. At this level, the bank begins asking a different question. Not simply, can you do the job, but can the bank make money because you are here? If the answer becomes yes, you may reach the final standard rank, Managing Director. Managing Director is one of the highest standard titles in investment banking. There may still be group heads, regional leaders, partners, or senior executives above the position, but within the ordinary deal team hierarchy, MD is the destination. The title brings prestige, access, and potentially extraordinary compensation, but it also brings one simple expectation.
Bring business to the bank. The MD owns senior client relationships. They may advise a chief executive on an acquisition, help a board decide whether to sell the company, discuss financing with a chief financial officer, pitch an IPO, or introduce a transaction idea before the client has decided to act. The junior team performs the detailed analysis. The associate reviews it. The VP controls execution. The director develops the opportunity, and the MD attempts to win and protect the relationship. The MD's greatest value is not the ability to correct a formula faster than an analyst. It is knowing which company might buy the client, which investor could provide capital, how the board may react, whether the market is ready, and who needs to be persuaded. At this level, relationships become economic assets.
Recent estimates place junior managing director base compensation in New York around $400,000 to $600,000, with total annual compensation commonly estimated at approximately $1 million to $2 million or more. Highly successful MDs can earn considerably more. But much of that compensation may be variable, deferred, or paid in stock. If transactions slow, clients choose competitors, or an MD fails to generate enough fees, the bank may question their value. At the analyst level, you fear making a mistake. At the managing director level, you fear becoming economically irrelevant. That difference explains why the pay rises so dramatically. The analyst is mainly paid for time, accuracy, and production. The associate is paid to review and coordinate. The VP is paid to control execution. The director is paid to develop opportunities. And the MD is paid for judgment, relationships, and revenue. This hierarchy also exists because every transaction requires multiple layers of work. Information moves down the team as assignments, then moves back up as reviewed analysis and strategic advice. Each rank asks a different question. The intern asks, how is this work performed? The analyst asks, are the numbers correct? The associate asks, has the work been checked? The VP asks, is the process under control? The director asks, can this relationship become business? And the managing director asks, will the client trust us with the decision? Behind these titles are also regulatory obligations. In the United States, professionals performing covered investment banking activities may need the appropriate FINRA registration.
Investment banking representatives generally must pass the Securities Industry Essentials exam and the Series 79 exam. Candidates are generally associated with and sponsored by an eligible FINRA member firm. Additional activities, such as actively selling securities, may require other registrations, depending on the role. The higher you rise, the greater your authority becomes, but so do the consequences of failure. And promotion does not eliminate pressure. It only changes its source. The analyst suffers from a lack of control over time. The associate becomes responsible for other people's work. The VP becomes responsible for the process. The director faces the uncertainty of business development, and the MD must generate revenue repeatedly. This is why most people do not travel directly from intern to managing director. Some analysts leave for private equity. Others move into corporate development, investing, startups, or operating companies. Some attend business school. And some discover that they enjoy financial analysis, but not management or sales. The career does not become a more prestigious version of the analyst job. It becomes a different job.
Endurance gets you through the junior years. Judgment gets you through execution. Relationships get you through the senior years. And revenue keeps you at the top. Your life on Wall Street begins with almost no authority. As an intern, you are being evaluated. As an analyst, you build the work. As an associate, you check and coordinate it. As a vice president, you control execution. As a director, you turn relationships into opportunities. And as a managing director, your value depends heavily on the revenue you generate. Your compensation rises, your title improves, but technical ability alone protects you less and less. At the bottom, you can prove your value with a correct model. At the top, no spreadsheet can guarantee that a client will hire you. An analyst can work through the night. An associate can check every number. A VP can manage the process perfectly. A director can develop a strong idea. But if the client chooses another bank,
the revenue may still be zero. First, the bank asks, can you do the work? Then, can you lead the work? Finally, can you create the work? So which rank has the hardest life? The analyst, who has almost no control over time? The VP, responsible for everything that goes wrong? Or the managing director, whose value is measured by the business brought into the bank? Drop your answer in the comments, and subscribe if you want to understand how Wall Street actually works, not as it appears in movies, but as a hierarchy of work, judgment, relationships, and revenue. Because the biggest promotion is not when your title changes.
It is when the bank stops paying primarily for what you can produce and starts paying for who will answer when you call.